Hello and welcome to this next lesson. We are going to dive a little bit deeper in the overall approach and we're going to talk about something which is generally considered to be one of the most important things you need to understand about the markets, and that is liquidity in the markets. And without this, the whole operation essentially becomes null and void. Without liquidity, there is no markets, there is no trading, there is no nothing. Liquidity is everywhere in the markets. And our job is to understand perspective towards liquidity in the markets and what we're looking to achieve with it and how we can utilize liquidity in the markets to frame entries, areas of interest, and targets. And we need to make sure we are acting as the right side of liquidity in the markets within the edge that we're going to teach. So first and foremost, what is liquidity? Liquidity is the availability of liquid assets to a market that can be bought or sold. That's the definition of liquidity in the markets. The foreign exchange market is very liquid because it's tradable 24 hours a day, 5 days a week. Now, this is the foreign exchange market. This is not just including other markets out there, like the stock market, for example, the futures market, the crypto market, the options market. We're just talking about using this as an example, but just understand when I say the foreign exchange market, I mean this is one of many markets which is very liquid with liquidity. And the foreign exchange market sees nearly $6 trillion turnover each day. And this is just the Forex foreign exchange market alone. This doesn't include stocks. This doesn't include crypto. So one of the funniest questions I get is when someone approaches me and says, is what if everyone trades the way we want to trade and everyone starts winning? Does that mean liquidity dries out or something like that? Let me tell you now, you will never be anything more than a drop in the ocean compared to the movement that happens in the market every single day. We only want a small piece of profit from it, but a small piece, a microscopic piece of profit from this market is enough to set you, your family after you, and generations up for life. That is how much money is in the market. It doesn't matter if you aspire to make billions of pounds in the market. You guys, you here, will always be a drop in the ocean when it comes to liquidity in the market. So you've got different types of liquidity. You've got smart money, you've got retail, institutional traders, all act as a liquidity provider. We also have, which we've explained, dumb money as well. And that is essentially people that do just buy a broker, put money in and press buy or sell, completely gambling their assets away in the hope that it's just going to move in a certain direction. And they act as liquidity provider as well. So we need to identify liquidity pools in the market. And we're looking for extended consolidation ranges. And I'm going to show you exactly what these look like. Swing points, which is going to be highs or lows. Consolidation, again, equal highs and equal lows. I'm going to show you all of this. We've got daily and weekly highs or lows. We've got logical stop loss areas. And we've got either side of session ranges. But essentially, those will come at, again, highs and lows. So let's now move this into a chart. Now, what we have on TradingView is we have this bar up here, which tells you the time frame you are on. So this is now a 3-month time frame. All the way down at the bottom is a 5-second time frame. What I want you to understand is that this level right here is a low. And this level up here is a high. And this area here is a high as well. And this area here happens to be a low. What you have to understand is that if you go all the way up to a 3 month chart, you've also got this low. You've also got this high. You've also got this low and this low and this low, as well as this particular high. What I'm trying to say and the point I'm trying to get at here is that whether you're on a 5 second time frame or a 3 month time frame, price is fractal. What that means is the same movement that happens here is the same movement that happens on the 5 second time frame, on the 1 minute time frame, on the 5 minute time frame, on the hourly time frame, on the 4 hour time frame, on the weekly time frame, and up to the 3 month time frame, even up to the 12 month time frame, which has all of the data that has been created since January 1967, all the way up to now, January 2025. The reason I've got this 3 month chart up is because I think it's really, really clean in what it's looking to do. And my message to you, just to get you to understand the basics of what we're looking for in terms of liquidity, comes around looking at two different things. The market is interested in two things, predominantly two separate things. And no matter what your strategy is, no matter how complex you make it for yourself, you have to keep going back to the basics, and you have to understand that the market is only interested in two things. How we get in and out of the market is completely irrelevant. The market is looking to seek towards areas of liquidity, number one. And number two, it is looking to do that from rebalancing into areas of inefficient price action. Now, this is another lesson for another time. But once I've done this next lesson, you are going to be ready to understand both things. For now, we're just focusing on liquidity. So we, as traders, are looking to identify certain ports of liquidity. The first one is going to be sideways movement. And that is when you get price action forming with equal highs and equal lows. That is consolidation in the market. You have traders placing orders at these levels right here. When they place these orders at these levels, that is liquidity being injected into the market. That is opinions being formed all around the marketplace. Millions and millions of orders are being pumped into the market every single time. That is what moves price in its direction. If price is more bullish than bearish, and what I mean by the frame bullish is price moving higher, so that is bullish price action. And what I mean by price action moving bearish is price action moving lower. That is bearish, as we know. And if you don't know that, this is obviously just a reminder of the basics. If you see more of a bullish frame, that is telling you that orders are stronger towards buys than they are to sells. But it leaves something at the bottom like this low, which is right here. This is sell side liquidity. Liquidity is at the bottom on the sell side. Above you to the upside is something called buy side liquidity. And price action is likely to sweep towards this area of liquidity here and come and target the opposing liquidity down here. But when you see sideways movement like this, you can expect certain price movements to happen after in order for price to take that high. If price sweeps the high and then looks to sweep a low, this is creating a trading range for you to work off of, where you can look for sells on the basis that we have swept this area of liquidity and we have swept this area of liquidity as well. And one thing you have to understand is that if price is going to be moving in a bearish format, you actually want price to go higher first to seek out levels of liquidity like it's doing there. And then you want price to shift in its intended direction to the downside, taking out more liquidity, which will then allow you the chance to get in on a trade and target the sell side liquidity. And it is usually looking to rebalance out of certain areas. Now, the other frame of liquidity that we have is in the form of this trend line right here. This is a bullish frame. And then the opposing side would be price action trending lower. This is a bearish frame of movement. Now, we are focusing on liquidity to be forming at these lows and also the highs. So when we see price action trending higher, we can assume price action is going to come into an area of inefficiency and then come lower. We can see that price action is creating liquidity. And if we can get our confirmation for a trade in this area right here, which again, we're going to talk about in a future lesson, we are targeting this high right here. Likewise, for a sell, if we can identify a level of interest and price action comes back to that level in a bearish market, this is liquidity at that low right here. You can see that price action was sweeping these particular lows, which are sitting right here as well. Now, when we get our confirmation for a sell, which is taking place in here, we would look to target sell side liquidity carrying on this trend. What you have to understand about the markets in this example is that actually as well, in doing this trend line moving higher, we are creating another form of liquidity. And that is a trend line form of liquidity, otherwise known as resting liquidity. Now, resting liquidity, once again, is a target for traders because there is a strategy out there called trend line trading. And it was actually the very first strategy I tried to learn. And I thought it was going to be really easy to pick up. But what you have to understand about this market is that it does not work in just strictly trend lines. And after a while, when price is overextended in a bullish frame, price action will actually completely violate this new area of interest. So where you might be looking for a trade in here, you would get stopped out of a position because price action's beginning a reversal in the market, which is then going to target all of this resting liquidity right here. Now, you could get a position in the markets. Let's say there's another area of interest right here, which again, we're going to talk about in another lesson. And if you get a position in here for a particular setup, you might have an opportunity to then take a buy, targeting that high on the comfort of knowing that this resting liquidity has been taken and price action can move to the upside and continue moving higher. Likewise, if price action creates this area of interest and you're actually looking in here for a setup now, after a while, we're going to create this huge sell side trend line of resting liquidity. When price action decides, actually, I'm going to violate this area and push higher, it is actually coming to target this resting liquidity, which lies right here. Maybe it's coming into an area of interest on another time frame, and then we could potentially get a setup to continue targeting this price action moving lower. This is all perspective and subjective. What I mean by this is there isn't a guru out there or an educator out there that can absolutely tell you that this resting liquidity, for example, is going to be targeted, or this consolidation is going to be targeted, or this particular trend line of movement right here is going to be respected every single time. We do not know essentially for definite when things are going to reverse. We can utilize tools to help us identify when there's going to be reversals in the market. And that is when we get into the business of creating or bringing up another asset which should correlate. And we would actually start looking for things like divergence in the market, which again, I'm going to talk to you about a whole separate module. I'm actually just moving the needle a little bit further along as we speak, but this is a way we can anticipate resting liquidity to be taken or lows to be taken or something like that. Now, another way we can look to identify certain areas of liquidity is by focusing on the sessions. Because basically, if we can identify that this area of consolidation is a particular session, we could essentially call this, let's just use this as the Asian range. This here is where you take a time zone, which again, we're going to go into time zones and stuff, but just use this as a frame for now. We're going to go into this area here. We're going to utilize the Asian range and we're going to wait for price action to open up in the London session. And inside the London session, we would anticipate that a target for price action would actually be this high and then this high. And if we can make this work, we would look to create more resting liquidity to be provided in the markets for the New York session, which hopefully would help us identify a bias for the day, sweep this liquidity right here, and then target sell side liquidity. So now we are utilizing the Asian range, the London session, the New York session, and we're looking for areas of inefficient price action, areas of liquidity to be targeting all of our areas and needs. So if we were now to go all the way back up to this level here, we're on a 3-month time frame. Price action is inside this area of inefficiency. This area right here is my target for price. The reason I would like this to be my target is because you can clearly see price action is pretty bullish, moving higher. It doesn't look as clean as what I've just drawn it. However, this is clearly the direction it wants to move into. So if we go to a smaller time frame now, you can see price action is sweeping this high right here. Price action is now coming back into this particular range. We do have liquidity here. We do have liquidity here. And we also have liquidity here. So there's liquidity everywhere on the market. These are levels, but we're looking to identify bullish frames. So we could assume price action is going to react inside this particular area here to continue moving higher to target this liquidity. And on a smaller time frame, it will do something like this to eventually target this high right here. And that's what it will look like on a smaller time frame. So we can get in potentially here. We can get in potentially here. We can get in potentially here on these retest levels. Once we identify those areas, we can obviously look to act on them. Now, if this area gets violated, which it looks like it could, this would be the target. And then we would probably create another area of inefficiency to then start targeting this new area of liquidity, as well as this longer term area of liquidity. And if you go to smaller time frames, once again, you can identify right here, just as a really good example, we had consolidation in the markets. And price action here, as you can see, went lower right here before it went higher. And price action went higher here, retraced back down, pushed higher, and actually gave you a retest in this area right here. And then you can see price action targeting liquidity here and here, and essentially pushing its way to the upside, targeting more liquidity. We are going to go deeper in liquidity, but for now, I just want you to look at the charts, identify equal highs, identify this liquidity grab here, and see price action moving lower, reacting inside these areas of inefficiency, targeting this level right here, because price action will sweep higher before it wants to go lower. So just familiarize yourself with highs, with lows, with session highs, session lows. We will go into timings, or we will go into more detail, and you can do this on any time frame. And then all we're looking for is to help you identify these areas of liquidity. So with that, do some practicing, and I will speak to you on the next one.